Alright, so welcome to episode 11. I think, yeah, episode 11. Well, I don't know if you made it this far. This is probably the most important episode that there will be, and it is on probably the most important thing, which is liquidity. So, we'll start off simple. What does price chase? Now, price chases three things: imbalances in price, which are PD raise, order blocks, fair value gaps, liquidity, which is what we're going to learn today, and equilibrium, which is just the the discount level of the range. So yeah, we did that last episode, so go back and watch that if you don't quite understand it, or ask me any questions, because I don't think I explained it too well, because I was trying to keep it really simple without going into how I use fib. But yeah, equilibrium is just the 0.5 level of a range. So yeah, today we are doing liquidity. So what is liquidity? All liquidity is resting money in the market above or below highs and lows. That's all it is. So it's usually people's stop losses, but just think of it as money in the market, which the institutions are going to want to take before a move, and they're also going to want to target. So they're going to be hunting liquidity. That's kind of the best way I can simplify it, because obviously it's a lot more difficult for me to teach these basics, because I can't throw in terms. I've got to keep it as simple as possible. So it's actually quite difficult to teach the basics, because I'm trying to keep it as simple as possible. So simply, that's all liquidity is: resting money in the market above/below highs and lows, and price is going to want to take the liquidity before a move and then target the opposing liquidity if it's in line with the trend. So anti-bias, it acts sort of like a magnet to price, because obviously it's money. The institutions want to make money, so they're going to take out these highs and lows, and because they want to make money, and once they do, they will make money, because it's usually people's stop losses. That's kind of a simple way to put it. Right, so in liquidity, I've split it up here into external liquidity, which is buy side and sell side liquidity, and internal liquidity, which is low resistance liquidity. Right, so if we look at this chart here, just focusing on up to where my line is now, you see we've got this low, which is a swing low, because it's the before. So we'll just you can still see the candles, but just ignore that bit. Just focus on this bit for now. So you've got this low, which is a swing low, and this high, which is the swing high. Why is it a low? Why is it a high? Because it's the lowest low, and that's the highest high. So a lot of people are going to have orders with the stop losses below these lows and highs, because that's generally just what people do. So say someone bought here, there's going to be a lot of lows, especially with buy side and sell side, or external. I call it external liquidity, because it's outside of the range, because they make up the range. So this is the low of the range, this is the high of the range. People are going to likely place the stop losses here and target, I don't know, whatever they want to target. There's going to be a lot of stop orders here, so that means there is a lot of resting money around this area. So when you see a low, the low of the range, so the lowest low on whatever time frame you're on, that's going to be sell side liquidity. So there's going to be a lot of resting orders, so it's very likely that price can take it. Remember I said can, it's not definite. Nothing in trading is certain. So just imagine a bunch of pound signs here. There's a lot of resting money here, and then this is the high, so this would be buy side liquidity, or again, external liquidity. There's a lot of resting money here. So price is going to want to take that so they make some money and then continue wherever it needs to go next, if that makes sense. So go on here now. As you can see, this low was formed. Price went up, buy side liquidity. Price then takes buy side liquidity, and what does it do? It goes and takes sell side liquidity. So you see this line here, that's sell side liquidity. So once it takes this, this would be the new buy side liquidity because these lows, and when you see equal lows like this or relative equal lows, this is a very good high probability form of liquidity because there's going to be a lot of orders here. So it's very good to target because remember, liquidity is used as a target. So as you can see, it takes buy side. This would be the new buy side, leaving these equal highs here, or relative equal highs. You can see the highs are all nearly the same height. And then price shoots down, and what does it do? Takes sell side liquidity here. And then price continues up again and takes the new buy side liquidity. That's just how price moves. They want to make money, so they are going to take highs and lows because that's how they make the money, because people's stop losses see, if you wanted to short to sell side liquidity, a lot of people are going to place their stop losses there, and they may want to sell there or even further on. That could be the first target, there could be higher targets down here, but hopefully you get the preference. So liquidity is resting money. Remember, buy side, sell side, low of the range, sell side, high of the range, buy side. And usually they target opposing liquidity pools, which are down here. And now we'll go over internal liquidity. So remember, buy side, sell side is external liquidity, which is more high resistance liquidity. Internal is low resistant liquidity, so it's highs and lows within the range. So for example, here you've got these highs here, so that would be low resistance liquidity or internal liquidity, and obviously you've got this low in here, which lows like that are quite because they're lows that reject something are quite good to use as forms of liquidity, but do a bit more on that when we get into my strategy. So this here, you can see these highs here, that's low resistance liquidity. It doesn't take a lot for price to take it. So price goes down, price takes the liquidity, collects the money. You can see here, all these highs, they're generally not sweeping each other. So all these highs, there's resting money here. What does price do? Taps, takes sell side, and then moves up. That's kind of how I see price and how price moves. I believe that price needs to take some form of liquidity before moving in the direction I want it to. So that's generally what I look for. Like I want significant liquidity, like sell side, to be taken, so price gets the momentum to go and take an external target, let's say up here. Like this would also be buy side liquidity. So if we want to target that, price is going to need something pretty big. So take sell side. You've got also all of this low resistance liquidity here. Got the sell side, price comes down, takes the sell side, and obviously it's going to easily take all this liquidity. So you enter a buy position maybe here, and price has a really good reaction. And that's generally how liquidity works. Buy side, sell side, both forms of external, low resistance, which is just highs and lows within the range, which is pretty easy for price to take. I will do a video on engineered liquidity when I do my strategy, which is what I use, and it's simpler, but you just need to understand it's highs and lows within the market. So you'll get used to spotting highs and lows and which ones are good. Like obviously you can see these lows here. These lows are equal lows. So remember what I said about up here? This is relative equal highs. These are equal lows, like pretty much dead on. So this is a good form of liquidity here. So say you saw something that made you want to buy up here, then you'd want to target this here because you use them as targets. So say if you saw, I don't know, absolutely anything in there, a lot of people would place their stops here and a lot of people would target this here. And then look, trade played out perfectly. So hopefully you do get liquidity. I might do a second video off it if I get complaints that people don't get it, but I'm pretty sure you should basically get it. It's resting money in the market that price is going to want to take, and you should be able now to identify the different types. So buy side, sell side, low resistance, equal lows, relative equal highs. Remember, it's relative because they're not exactly equal, but they're pretty much equal. And yeah, more low resistance. So hopefully you get it. Pretty much every one of your trades needs to be involving one of these three things, but every trade realistically should involve liquidity. When you're trading, you need to be thinking, what is price taking? And it's got to be one of these three things. Where is the market going? What do the institutions want to target? So say when I'm here, I'm going to be thinking, right, we've swept all sell side liquidity. We've took out all of this low resistance liquidity here. Remember, because it's inside the range. We took out all of this, took out these equal lows. So I'm pretty certain, and because I've got a bullish bias anyway, because that's just what I want my daily bias out to be, I'm pretty certain that price is going to take out these highs here. So I'll put on a buy position. So that's a sell. I put on a buy because I find whatever confluence is around this level, I drop down in time frames, see if we've got an order block, whatever, and I target these relative equal highs here, which you wouldn't use a stop that small. We are on the 50-minute time frame because it's just the easiest to see. But yeah, so remember, in the range, sell side, lowest low of the range, buy side, highest high of the range. And then when buy side gets swept, it's very likely to take the opposing liquidity pool before continuing with the overall trend. And highs and lows inside are internal, and they are generally low resistance. So yeah, any questions, please let me know. If you want to mark out buy side and sell side liquidity and send them to me, and I'll tell you if it's correct, because it is very, very important you do understand liquidity. So yeah, bye.